And you have mentioned something to do with the tax plan, and I can't help but to ask, how is taxation shaping our country? Because we have seen a lot of big firms, big industries, big companies exiting our market because of maybe severe tax punishments. Our taxes are high, they cannot sustain the market. How is that affecting our market?
So you've heard of investment bankers, right?
Yeah.
So
What is their work, by the way?
In a nutshell, in summary, what investment bankers do is connect people who have capital and the people who need capital.
Okay. What is the biggest risk facing investors in African markets?
Greatest risk, currency fluctuation. So you'll notice most funds, private equity funds, invest in hard currency, mostly dollars. Okay. But you're investing in an economy that don't use dollars.
Okay.
Yeah.
What makes the African market unique compared to the global market in terms of private equity?
There are very many angles to look at it because that's a very wide question.
Yeah.
But
how do you guys manage risk?
Risk is part of the process. So risk is part of the process, but it depends with what kind of risk.
Hello everyone, welcome to Sango Insights. This is the third episode in March, and today we are privileged to be joined by private equity investment professional. She has 6 years experience in private equity management, fund management, portfolio management, and mergers and acquisition. Her name is Grace Njuguna. Grace Njuguna, welcome to Sango Insights.
Thank you.
And Grace Njuguna, to the lay person, what is private equity?
Private equity, in summary, is getting equity in a private company. Equity means shareholding in a private company. In a nutshell, that's what it is. Getting stake or ownership in a private company in form of an investment most of the time. Okay.
And where do the private equities invest? Do they invest in a mature business or which is profitable, or do they invest in startups?
Okay, so the private capital market has both private equity and venture capital.
Yeah.
With venture capital mostly focusing on the early stage businesses. These are mostly businesses could be at the ideation stage. Yeah. A business without many years of operations and not even profitable. But private equity companies, investments focus on companies that have been in existence for some time and most of the time profitable as well. Yeah.
Grace, you are a finance person. You are well accredited in terms of finance. What motivated you to be in this field of finance and investment?
Okay, so in school, I was good in math and I enjoyed business studies, which was compulsory. So I felt like a natural transition in career-wise could just be in finance, and that's how I ended up in finance.
And a lot of people who are good in math, they go also for actuarial science. They go for these big courses. But besides math, what is that thing which made you want to be in finance, in private equity, portfolio management?
Okay, so starting out, immediately after school, I didn't even know private equity existed. It's just that I knew I was good in math and I always wanted to do something with investing. Because it's something I was exposed to when I was younger. So I just wanted to know more about like investing in shares, what bonds meant, because I had a general understanding from growing up, but I knew I wanted to focus on something in investments. So that's why immediately after school, I was fortunate enough to work for a fund manager in the capital who focus on the capital markets.
Wow.
These are publicly listed securities, shares and bonds. Yeah, so that was the first place I worked, then transitioned to private equity. So my general experience in the 6 years is both capital markets and private equity, with private equity being the last 4 years. Yeah.
You have experience of 6 years, Grace Jugon.
Yeah.
What was the most important skills in your first year in your career? The most important skills?
Do you mean in private equity or
in
previously?
private equity.
Okay. So when I was transitioning to private equity, I was looking to, or rather when I was looking to move jobs, I knew I wanted to be in the investment space, but wasn't really sure like what specific sector or area of finance. So when I saw the opportunity on LinkedIn, for the private equity company I worked for, the requirement was just to have a finance background.
Okay.
Because most private equity companies hire people at the junior level, then you train and you grow your way up. Yeah. Exactly. So finance, the ability, like first general understanding of financial statements, because you deal with the financial aspect of a business as well, and the ability to analyze these financial statements and make sense out of them from an investment perspective. Yeah.
And at what point do you require? You say that the basic, you just require general financial acumen.
Yeah.
At what point do you require these professional courses like CPA, CFA, SCCA?
I see. Okay, so I happened to have done ACCA during when I was in school as well. And the understanding it gave me was how financial statements operate. So there are 3 key financial statements: the profit and loss account, the balance sheet, and the cash flow statements. How to understand what these 3 means and how they're interlinked to each other. That was one part. Then coming to the investment part, so even when I was working at the capital markets, there is something you learn called financial modeling, and you need to have a very solid understanding of financial statements. So ACCA gave me that background. Now the next thing was just being able to do financial modeling. This is being able to forecast like the financial performance of the company based on what you know now and what you expect the future of the company and the industry to be, and then getting a value, like getting a value or assigning a value to a company based on that. So that is the extra skill you get out of being in the industry. But the ACCA really gives you that good understanding of how financials work. Even you go to the nitty-gritties of each line item and now how everything relates to one another. Then coming to CFA, which is a Chartered Financial Analyst certification, it's focused mostly in investment and financial analysis. So it teaches you how to understand a company better, an industry better, what to take into account in your valuation. It teaches you the numerous methods of valuation and what each looks at and how each is suitable for what sector or industry. In a nutshell, it's quite wide, but in summary.
So you have applied whatever you have learned in both courses, that is the ACCA and the CFA. Your private equity, do you invest across Africa or it's only Kenya?
So essentially private equity so there's normally a fund that raises money. And this fund now deploys the money to different companies or investments. So each fund has a different strategy and mandate. So there are funds focused on like the whole of Africa, others are specific like East Africa, Southern Africa, Sub-Saharan Africa. And then there are some that are sector specific. They say we invest in healthcare, all of Africa or sub-Saharan Africa, education, Africa, like that. So different funds have different strategies. But my experience, I've had the experience of investing in East Africa and currently Africa across various sectors.
Okay.
Yeah.
What makes the African market unique compared to the global market in terms of private equity?
There are very many angles to look at it because that's a very wide question.
Yeah.
But from a capital structure perspective, which is like the art that is in the industry, it's the art part, not the science part. It is how the availability of financing. So in the global market, it's very easy. Well, it's much easier to raise capital than here because private equity it's not very well understood here, because even most of the money in our industry is mostly from development finance institutions, which are global or outside Africa. A good number of them. So the local capital here is yet to warm up or fully understand the industry. That is one. Then second, the cost of capital. So global private equity funds or investments can easily leverage debt in their transaction. You can acquire a company through debt because debt is cheaper. I mean, you can get debt at 5% interest rate.
The percentages.
Exactly.
And ours is like 11, 12%. They go up to 15, 17%.
That's in our African market, which
Kenya to be specific.
Exactly.
Yeah.
So that's another. It influences how you structure investment. So here, of course there are debt funds which are not so well. There are debt funds as well, and it's also something that is the market is trying to warm up to as well. But you find most of the capital here is equity because it's from a cost perspective. I mean, the price you pay it's much lower. That is in terms of interest rate, right? And then also our capital markets are not that well developed, but we are getting there. So it's very easy for a global market. You have a company, and then when it comes time to sell it, you can just list it on a stock exchange, and you return your money at a very good multiple. We haven't seen much of that in our African continent. Okay, let me speak more specifically for East Africa. But
do you mean the exit strategy?
Exactly. Exactly. So most of the transactions here have to be financial buyers or strategics. The exit through capital markets, it's something that hopefully will be there in the future, but we're yet to get there, like in a robust way. Okay. Yeah.
Is private equity regulated by the Capital Market Authority, or who regulates the private equity in Kenya, to be specific? In terms of their dealings, in terms of their regulations, in terms of their everything they do?
So the Capital Markets Authorities mostly deals with the capital markets and the listed securities. However, on the private equity side, what we do is notify the regulator of the intended transaction. So most of the time, because it's mostly an acquisition or a merger that may or may not, or may have an impact on competition. So the people notified at the Competition Authority of Kenya.
Competition Authority of Kenya.
And if it's a fund with a regional presence, let's speak of, so that is for East Africa. For example, you have to notify COMESA. Exactly, and then they have to, of course, they can give, they give the guidance if they have approved the merger and the acquisitions and any restrictions they may have on that. But for now, those are the two main regulators. Exactly. Okay. From a competition perspective.
And which sectors do you guys prefer mostly to invest the private equity? Is it energy? Is it fintech? It is infrastructure? Is it agriculture? Which is the booming sector in Kenya?
This is dependent by the fund strategy.
Yeah.
So as I mentioned, there are very many funds. So there are funds that only do infra. There are funds that do renewable energy. There are funds that focus on healthcare. There are funds that focus on education. There are funds that are general. They focus across all sectors. So it's purely dependent on the fund strategy. So if a fund is dependent, for example, if a fund is focused on the healthcare sector, they probably don't look at financial services because that's not their area of focus. But maybe to monitor things that are evolving in that sector. So like right now, technology and AI is a reality that each sector has to take into account.
How is it shaping our markets? How is it shaping the private equity, the technology?
It is becoming a cornerstone and quite important to take into account because you don't want to be in an industry that is going to be phased out in AI in terms of investment, but also need to be very, very deliberate to incorporate technology in the companies you're looking at. So for example, healthcare, if I may use healthcare as an example, or even education, there's the brick and mortar kind of healthcare, the primary healthcare. You have you've invested in a hospital that treats patients, right? But now we're evolving into telehealth. And then
what is telehealth?
When it's like the online platform of healthcare where you can contact a doctor online. There's such platforms that are evolving, and with technology, it becomes very easy for you even to access healthcare globally with that service, right? And then there are things like even online delivery of medicine, like what MyDawa or even most like Good Life already has it in their services. Your ability to order medicine online, even get a prescription from a telehealth practitioner. So those are the kind of changes that we are seeing, and they are different for different sectors or industry. So you just have to be very deliberate that your uptake of technology for the companies a private equity fund invests to they're not left behind by the industry. Just need to make sure you're moving with technology, exactly.
Okay. What as Grace Njuguna, someone who has 6 years experience, what is the biggest risk facing investors in African markets?
Greatest risk, currency fluctuation. So you'll notice most funds, private equity funds, invest in hard currency, mostly dollars. But you're investing in an economy that don't use dollars to do their day-to-day transactions. So that is something that has impacted most investments in most countries. I mean, even our country, we experienced that some time back. So you, as an investor, you've put many million dollars into a company. The company is probably even doing well, it's growing, but at the time of exit, the currency is working to your disadvantage. So investment, because you have to return your money to investors in hard currency, your return feels like you didn't do the work. And so that's like one of the biggest. Then we have some like changing regulations that are affecting certain sectors to your disadvantage. And of course, AI, technology, as I mentioned. And I think Africa has this is not a risk, but
we have a political stability. Instability
even political, Thank you for mentioning that, because you will see as the most election year, around the year of election, that you see most investors tend to have that wait and see
by the way,
attitude to just,
and some of them even withdraw their funds and everything.
Just wait to see how things will span out, and then which is a lag on the investment industry, but for sure. And then geopolitics as well, because if you have a company whose main raw materials or main customers are affected, or they have to export, and their markets are affected by the geopolitics.
Like what is happening now,
exactly.
the US America Israel war.
Absolutely.
I mean, America, Israel, and Iran war. So it's affecting a lot of things. Even fuel now, we have we may be facing a shortage of fuel in the coming days. How do you evaluate a potential investment?
So evaluation first depends with the industry and the sector of the company. I would put it into, for private equity, as I said, you're looking at a private company. So first, there's no public information about the company, and then probably the industry. So I would put it into like 3 buckets. So there's the fundamentals about the company. How is its growth in like revenues? How is its margins? And then you compare this with the industry. Is it doing better or worse than the industry? And then of course you have to understand the industry as well. Where is the industry heading? Is there opportunity for more growth? Because the expectation is that you're investing in a company that's going to grow and you're going to sell at a higher valuation. So that is one. The other one is relationship. So private equity is a very relationship-based industry, because first you have to create a relationship with the person you're going to invest in, and they have to know you as well. So they have to be a bit of chemistry, and then trust, such that when we agree this is a strategy forward in the company, we are going to stick to that, and we're not going to cut corners and the likes. So that is one. The other one is regulation. So the regulator has to approve the transaction, and also you have to be cognizant on the regulations in that sector and industry, and how they will affect your ability to sell that company in the future. But right now, more and more, we are seeing a focus on ESG. ESG is environmental, social governance, and impact. So there's a focus on companies doing the right things. That is, are they like disposing waste of their operations in the environment, which is not right? Are they paying the employees well? Then even gender diversity is becoming something of emphasis nowadays, and focus on youth and women and governance. Like, what is the reputation and brand of the company out there? So those are becoming very critical areas of focus right now.
That is well put, Grace Njuguna. Can you walk me through a deal from sourcing to execution?
Sure. So sourcing a transaction or a deal for a private equity transaction can come through a proprietary network. So for example, I know you, we know each other, right?
Yes.
And I know you have a business, and you want to expand your business, and you need significant amount of capital that you feel, and patient capital. Private equity is patient capital. It's not like a bank where you're supposed to pay, you're given money to the next month, you're supposed to start paying already. So it's patient capital. So you want something, and then you want also someone
What is the duration you're being given for you to bear the fruits?
So most private equity funds have a fund life of 10 years.
10 years.
So in this
decade.
So in this time, you're supposed to, after you raise money, deploy the money into companies, add value to them, and have sold them. But you normally get, so essentially the average fund life is 10 years. So how you get the deals, to the prior question, is through your own proprietary dealings and connections. So if I know you the way you're saying, you probably want to expand your business, or there's an elderly family business, they want the business to be continued running, but their children probably don't want to be involved in the business. That's also another way, like you get such. The other way is through an intermediary. So you've heard of investment bankers, right?
Yeah.
So
what is their work, by the way?
In a nutshell, in summary, what investment bankers do is connect People who have capital and the people who need capital.
Okay.
So you can also get a deal or a transaction through an investment bank because they have visibility through people who come to them who need capital and ask the issuers of this capital. So that's the first way of getting, but investment bankers coordinate the whole process till execution. So that's one part. So once you have the company or the deal with you, so you have to first develop a relationship and get to know what they do. You probably even pay a visit just to see. And then so that's the first part. And then you have to start the evaluation part. So like I said before, there are like 3 key ways of evaluating a company, which is not exhaustive. There are many others, of course, depending on the sector and the fund strategy.
Yeah.
So you may probably sign a non-disclosure agreement for them to start sharing with you some documents. So for you to have a high-level overview. So they probably send some summarized materials. Could be an investment memorandum or a teaser. This is documents just highlighting what the business does and probably their financial performance, the industry they're in, the kind of products and segments they're in. Yeah. So you evaluate this. Does it meet your criteria for an investment? If it does, we go even further. You give an expression of interest to continue with the process and probably give an non-binding valuation, pending to them giving you more information. So now you get even more detailed financial statements. You get things like you can even speak to their customers, to their suppliers, just to interview them to get to know the business even more. And then you research more on the industry, right? And then, so the internal processes are different because...
How long does it take to fully execute and to fully take all those steps?
It takes time. Yeah. But it could be from 6 months, it depends with how the transaction is and the kind of relationship the two parties have developed with each other. It could go up to 2 years.
And how the company is compliant.
Exactly, and how easy they can supply the information you're asking for. And also, if you need a regulatory approval, that also takes time. Yeah.
Let's go to mergers and acquisitions.
Wait, I didn't finish the process.
Okay, finish the process, sorry.
So there are normally internal processes such that whenever at any level you have... So for example, after you understand the company, you can go to an internal investment committee these are third parties who help you to assess the investment together with you, and they could bring insights that you may not have looked at or you may have missed, and they help to guide the process as well. Then there's normally a commercial due diligence. That's where you engage external third parties like lawyers, other finance professionals, mostly in the advisory space, do a commercial study on the market, even a reputational due diligence, such things. And then you still see if they are still in line with what you had in mind for the company, and if they are changing your view and even the valuation you had attributed to the company. So once you clear this, so there, of course, there are normally some issues here and there, but you have to determine their magnitude for you to continue or not continue with the deal. So you can continue, but you put some conditions that we are going to do this deal, but you have to fulfill X, Y, Z from the outcome of the due diligence. And then from there, you go to the transaction documentation. This is where you put all the agreements in paper. The shareholders agreement, if you're going to, because private equity, you're getting equity and shareholding in another company. So these are shareholders agreement, how the shareholder relationship will be managed. This could be a share subscription or share purchase agreement if you're getting shares from another party or new shares are being issued by your presence. Yeah, and then after that, you have to notify the regulator, get the approval, and then close. Yeah. But there are normally some conditions that have to be fulfilled before the closing, depending on the outcome of the due diligence. Yeah.
Oh, it's quite a long process.
It is.
Mergers and acquisition. What makes a successful mergers and acquisition deal?
Yeah, so this is more or less like what I said about the private equity deals.
Yeah.
So first is the two parties, the relationship. Can you align on the way forward?
Yeah.
Right? Do you have a strategy that you're going to stick to together?
Yeah. Common goal.
Exactly, and the collaboration and one. So it's very good actually, because to have very good lawyers to help guide the process for both parties. Yeah.
And what are maybe the common mistakes companies make in mergers and acquisitions?
So you mean like potential companies to be acquired?
Yeah, the common mistakes people make.
Okay.
And the companies.
Okay. So we have to evaluate a company to get comfortable that we can invest in it, yeah?
Yeah.
So having proper systems and books. You know, so do you file your accounts? Do you file your returns? Like, do you have your books in your house in order so that
are you compliant in
exactly even your licenses wherever you operate, so that that actually makes the process much easier, so that when you're requested for information, it's much easier to share. So companies, very important to comply with all the regulatory requirements of the sector, and then have proper people within the company. So like a CFO is a very vital resource in a company, and them being even able to answer the questions about the books of the company is also very, very important. The other thing is having entrepreneurs doing everything. Like it's important to have that delegation and a team, and a team that has ownership over what they do, such that it's not like they say the owner knows everything. The owner, so it's also good for succession, so that when something happens to the owner, at least there's continuity in the business. Yeah, that's what I would say from my experience.
And how does ethical play part of these all processes? Because we know if there is unethical maybe acts or procedures, all this deal may crack. How does ethical play in investment, in finance, in equity, everything to do with money?
It's a baseline, because this industry is purely based on trust and relationships. Purely based on trust and relationships.
Are there some points these big companies do falsification of books? Falsification of books, trying to emerge as something they are not, so that they can attract or entice the investors. And how do you deal with those scenarios?
Yeah, so that is possible actually, especially with the books, because you normally hear there's a book for the taxman, which is not a very good thing. But when you're doing thorough due diligence, you'll uncover all these things. When you're doing a thorough due diligence, you'll uncover all these things. And again, as an investor, you don't want to be associated with a company that has bad reputation, because it also scars your own reputation. Yeah, so not being honest or not having true accounts or representation of what you do first ruins your brand, and also your chances of attracting capital, because no one wants their name ruined out of association with such a person. Yeah. So, but we do reputation due diligence as well, which informs these things. So we are able to know even something that happened even 5 years ago that can be uncovered.
And you have mentioned something to do with the taxman, and I can't help but to ask, how is taxation shaping our country? Because we have seen a lot of big firms, big industries, big companies exiting our market because of maybe severe tax punishments. Our taxes are high. They cannot sustain the market. How is that affecting our market in terms of taxes, government taxes, the regulatory taxes, the licenses, everything, a lot of processes? Those who want to invest in our country, I mean, the foreign investors.
Of course, from a regulatory perspective, this is not just being taxed. When we have very stifling regulations, of course, repel people who wanted to come in because there are so many things they need to go through. So
and
it's
a
not
lot of bureaucracy.
Exactly. So that works to our disadvantage when we need to attract capital, which is something we probably need to think about, right?
Is it right if the government gives us tax incentive to these foreign investors who are coming to invest in our country?
Yeah, that's a good thing. But actually, we've had, it's called the Nairobi. There's actually one body, sorry, I'm forgetting the name, that has already been established, where you get tax incentives, I think, for the first 10 years of operations.
Yeah.
Even we're having the SEZs,
The exporting companies.
Yeah, so when you decide to domicile your fund here, you get better tax terms or tax intensive.
Processing zones.
Exactly. So which is a good thing, but on the other hand, maybe for the tax is for maybe us to have those bilateral talks with other countries, because you see, most funds are domiciled in Mauritius and other countries, and it was mostly because of the tax terms, which are probably much better. So it's maybe important for the government to have those bilateral talks on, that's those tax treaties with other countries as well, so that we are more attractive that way, and also make sure that our regulation are not turning people away. People who or funders, they're not turning funders away.
And how does private equity manages risk? How do you guys manage risk?
Risk is part of the process. So risk is part of the process, but it depends with what kind of risk. Again, this depends with the sector and the region or countries that the company or the private equity is looking into. So you'll find most try to diversify away from one country or one sector. So that's exactly that is one way. And then probably focus on companies that first don't rely on one customer or one supplier, and then companies that have like you source your materials locally, so that when affects the foreign currency movements, you're not materially affected. Or companies that generate dollar revenue, so that at least you're hedged on one side.
What is the one of the biggest risks you guys have ever taken in investment? Can you tell us?
Maybe faced is what I would say.
Faced.
I think it was the currency one. I think most funds have faced that one, where you invested and then your fund has a limit, right? You have to, when your turn is approaching, you need to start exiting, and then you're exiting at the time when the currency has turned upside down. So,
and how do you balance the risk and return portfolio?
I mean, just like I said, diversification, both in country and in sector. And also private equity, so when you raise one fund, so it's 10 years, you return them and then you raise another one to continue investing. So you become more aware on what works better for you. So you even with time, you get to know the sectors that you'll probably focus on and the regions, because out of experience, and you're able to now implement those as strategies for your business. For the companies investing here.
As we wind up, Grace Njuguna, are we patient in terms of giving time the private equities to do their things? I mean, are we patient investors, us as Kenyans? Can we wait for all that period so that we can have maybe the profits and everything?
Are we, sorry, from a private equity perspective? Or?
Private equity perspective, yeah.
Yeah, private equity is patient capital by itself, right? So because, for example, when these currency issues are happening, you probably pause to exit a company, focus on growth as you wait for currency to stabilize, right?
Yeah.
But if you probably had debt, that would probably not be a consideration. You see,
Yeah.
you'd probably have to pay it despite the movements in currency or the likes. Probably you could get a restructuring. But the advantage of this is, first, you're getting money to grow your business, right? Not money you have to return every period. So companies pay dividends, which is a good thing. That's one way to return the money. However, we'll wait till exit. So now we focus on adding value to the business and growing the business. Then that way the business is even more attractive. Now the next question comes to finding a buyer to realize this value that you've been building all this time. Yeah.
There is no way you can pull out of your money if you invested in private equity if you're not aligned to that equity. I mean, is there a way you can pull your funds?
Like
maybe you have invested with private equity, like yours maybe. If I want to pull out my funds.
What do you mean? You've invested in a private equity fund?
Yeah.
And then you want so so at the beginning when you're investing, there are agreements you sign, and you know the fund life. You know when you'll be investing money. Whenever there's a new investment, you have to give money.
Yeah.
And then it says when you're expected to start realizing your money back. So you're governed by the documents you sign at the time of investments, and fortunately or unfortunately. Yeah. But that is something that can be discussed among the fellow investors to decide the way forward. But they are legal. I mean, it's a legal issue that it's normally taken into account at the beginning. Yeah.
Okay. Yeah. That is quite understandable. What is your advice to young investors, Grace?
Young investors?
Yeah. What mistakes should they avoid? Where should they invest their money? Which is more profitable investment? Should they go to money market funds? Should they invest in other funds? What is your advice? According to your skills, experience, knowledge, expertise.
Where should you invest?
Yeah.
Wow.
And what mistakes should you avoid maybe?
Okay, so the investment space is very wide.
Yeah.
So first you need to develop some form of understanding. Just like Warren Buffett says, don't invest in something you do not understand.
Yes.
That's like the first principle.
Yeah.
So, and you don't have to know everything. That's why there are experts for the different things. So if you're interested in the capital markets, you can, we have very, very many banks and the trading houses that you can consult. Right? But first, before you invest, you need to define very clearly what your goal is. What are you trying to achieve? What's your objective? That will inform what you need to invest in. That's the first thing. And then you have to be patient, just like the way private equity is patient. It takes time for money to be made for this. Even Warren Buffett started investing in his 20s, but he became a billionaire in his 50s. So, it takes time. Yeah.
That is a very profound conclusion. Grace Juguna, we thank you for your time, your patience, and also for honoring our invitation to come and give us your expertise, your knowledge for the fans of and audiences of Sango Insight. Thank you again, and we want to see you again and again. As we went up, we also request you to subscribe to our YouTube channel, hit the like button, and also leave us a comment about investment, finance, and private equity. Thank you so much.
Thank you.